Hi, and welcome to Looking at the Markets. I'm David Modell. Thank you so much for tuning in as always. I'm going to give you some cool stock and ETF trading and investing tips and tricks. All right, we're going to get to that really soon. Just a quick announcement. I have not been paid any money for any of the interviews I've done so far because I've done them for a learning experience for myself and to share the knowledge with you and to grow my YouTube channel as well. All right. And I've been very grateful to do those interviews. Don't be surprised if very soon I'm going to start doing some interviews of small companies, okay? Like smaller companies with a penny stock maybe, or a small company with an ICO, and that's an initial coin offering, things like that, all right? And I'll be honest with you, I'm going to get paid to conduct those interviews, all right? And that's a way to monetize my channel. I thought about doing YouTube monetization where they pay you a very small amount of money, all right, to put more ads on my videos, but I figured that wasn't worth it because I don't want to annoy you guys and gals with more ads because, again, the amount I would get paid would be very small. It wouldn't be worth annoying you with more ads for that, all right? But I wanted to start, getting paid a little bit, wanted to start monetizing because I've put out over 200 free videos, okay? So don't be surprised if pretty soon you start seeing videos where I'll be interviewing CEOs or founders or presidents of small companies, whether it's a penny stock they'll be promoting or maybe an ICO, initial coin offering. Doesn't mean you have to buy it, doesn't mean you have to click on those videos. If you don't like those, you don't have to click on those if you don't want to. But if you want to support me and you want to support these small companies, by all means, please click on the videos. That way you can help monetize my channel without having to pay any money yourself. It's a free way for you to support my channel, which is pretty cool. I appreciate it. And if you want to give those videos a thumbs up and leave positive comments, okay. So anyway, I just wanted to let you know about that so you're not surprised. All right, and they are not going to be pump and dump schemes, believe me. I'm not going to buy a bunch of I'm not going to buy a bunch of shares of a penny stock and then start promoting it to try to pump up the stock and then sell all my shares and dump it on you. This is not a pump and dump scheme. I'm not going to start taking positions in companies and then start promoting them. That's not what I do, okay? So just want to let you know that you don't have to worry. This is not pump and dump. Okay, so as promised, here are some cool tips and tricks for your stock trading and investing. If you like what I'm doing, please give the video a thumbs up, leave comments, and please subscribe to my YouTube channel if you didn't do that already. And if you already did, thank you so much. I really appreciate it. Thank you. All right, so here we go, and thank you for watching.
Here's a little tip or trick for stock traders. This can be used for both swing trading as well as day trading. You just have to change the time frame. One of my favorite patterns or chart patterns is when a stock is going sideways for a while or is in a tight range for a while and then it breaks out. I love a good breakout. When a stock just has very little volatility, just doesn't really go much of anywhere, and then suddenly breaks out of that tight range. That is great for a long position. It's also good for short positions. If something is going sideways or in a tight range and then it just breaks down, it has a breakout to the downside, then you can short it if you want to. And then because it's likely to just keep going down if there's really bad news or whatever the catalyst is, it's likely to keep going in that direction. Not 100% of the time. It doesn't always work perfectly. But the question is, how do you find these sudden breakouts or breakdowns? Well, you need a good stock screener. You don't need one, but that helps. A lot of people use finviz.com, F-I-N-V-I-Z. That's a very popular one. They have a stock screener that a lot of people use. But here's another one. Here's kind of a hidden one that maybe not everybody knows about. It's called Market Chameleon, marketchameleon.com, and it's a lot like FinViz. And these are all free. And so I like to use the free resources, and I like to save you money by introducing you to some free things on the internet. All right, so let's say you go to Market Chameleon. You would go to Stocks, hover over Stocks, and then go to Unusual Stock Volume. All right, because when looking for breakouts or breakdowns, you know, I don't just want something to break to the upside or downside. I want a lot of volume. I'm looking for real conviction in the move, and by conviction I mean a lot of volume, a lot of people you know, trading to the upside or trading to the downside, a lot of buying or a lot of selling. All right, because you know that means that it's likely to continue in that direction. Again, no guarantees, but so you know, when I look for unusual stock volume spikes, the spike could be to the upside or the downside. And so, for example, when I'm looking through here, look here, EFX, Equifax, right? And this is heavy volume going down 8%. To the downside, and then so I look at the chart, and you know, there it is, approximately 8%, and you know, going down even more after hours. All right, so you know, it's I mean, it went down, it gapped down, and it just kept going. I mean, there's massive volume here to the downside. Even if you had bought at the end of the day after hours, it just kept going down. And that, you know, it's coming out of a period of sideways action, and then boom, and it's just down, down, down. That's a breakdown. All right. Or another one I found on here was IIN, Intricon. This is one that I would not necessarily have found this one if it weren't for this you know, this feature on Market Chameleon, Intricon, and I saw, you know, a breakout on heavy volume to the upside, 15%. And actually it's even more than that, 22% by the end of the day. All right, so you know, again, there's some consolidation here. It's just going, you know, sideways, and then boom, a nice breakout. All right, so that's the kind of thing I look for a potential long position. And again, it's on heavy volume, so I know that this is a real move. This is not just some low volume you know, pump and dump necessarily. Plenty of volume here. I like to see that. All right, so there's a little tip, and you don't have to use this website. You can use FinViz or your own stock screener, whatever you like. Look for the heavy volume. Look for unusual stock volume, breakouts to the upside or breakdowns to the downside. Alright, now I'm going to give you a quick tip or trick to help you find support levels. That's one thing that I find to be very useful in knowing when to make an entry point, when to take a long position. I like to find not just double bottom patterns, but multiple bottom patterns. When a stock has gone down to a certain price or level and then bounced right off of it, let's say 2 times, that would be a double bottom, but 3 or more times, that's a multiple bottom, and that's even better. That's really strong support, and that's a great time to buy, especially if it's a really good company that you believe in. And so how do you find these? Well, I like to go to finviz.com. It's free right now to use them, and I go to Screener. Okay, so I'm clicking on Screener. They have a free, at least it's free right now, their stock screener. Alright, and then I like to go to, see where it says Signal here. Alright, and it says None. I'm going to go down to Multiple, here it is. You got to scroll down to the bottom. Multiple Bottom. Alright, and you click on that, and it gives you a list of stocks with multiple bottoms, but I really want to look at the charts. And so then I click on, see where it says Charts here. I'm going to click on Charts. And there we go, and it delivers to me all of these different stocks. Now, they're not all necessarily going to be great stocks, all right, but you know, you look through them, and you could screen it further if you just want you know, large caps, mega caps, that kind of thing. Okay, you can screen further, which is what I like to do. But right now, you know, I'll keep an open mind. For example, here's CVX, which is Chevron. Okay, that's a large company, and we can see a multiple bottom here. It hit this price point here, which is about 103, 1, 2, 3 times. And so if it goes down to 103 again, I'd say that's a pretty good entry point. All right, you know, so we're just going to look through it, and we can see, you know, all these multiple bottoms, all right, where it just bounced off of approximately the same level multiple times, more than twice. And that's a good sign. That's if it goes down to that price again, then you could buy it, and there's no guarantee. Of course it could go lower, but we're working with probabilities, not certainties here. And so if it goes down to that level again, at least you know you're getting in at a pretty good price, and that the market has demonstrated that that's a good price because it bounced right off of it at least 3 times and maybe even more times than that. Okay? So look for those multiple bottoms and try using them as support levels and possibly as entry points for a long position, but only with really good companies. We're talking about companies that do tend to go up over time. Okay, you don't want something that's a falling knife. Maybe something like this might be a little scary to get into. You want good companies. Like I would say Chevron, that's a mega cap stock. And so yeah, they might be having tough times temporarily, but if you look at the multi-year chart, I think you'll find that these mega cap stocks do tend to do well over time. So that's something to think about. Alright, now I'm going to give a really simple but unusual tip or trick. I've never heard anybody else suggest this. At least I'm sure somebody's thought of it before, but I've never heard it before. And I think this could be really helpful to keep your trading unemotional and more mechanical in a good way. Alright, so this is a very simple strategy, which is, a lot of people use this. This is not unusual, to buy when you put 2 moving averages up. And you could do this with day trading or with swing trading. I'll just talk about swing trading here, but you can adjust the time frame to use it for day trading. This is a daily candlestick chart of Starbucks stock, and it's on stockcharts.com. Want to give them credit. All right, and I've put up the blue line is the 10-day exponential moving average. The red line is the 20-day exponential moving average. And you don't have to use the 10 and the 20. You can play around with different numbers, and you don't have to use the exponential moving average. You can use simple moving averages. It's up to your preference. All right, so a lot of people do this. They'll buy when the faster moving average crosses above the slower moving average. So for example, when the 10 moves above the 20, when it crosses above, you can buy there. And then when the faster moving average crosses below the slower moving average, like here when the 10 crosses below the 20, that's when you get out, that's when you sell. Okay, and this doesn't work all the time, but it's a pretty good method. It's very simple. All right, so it's about moving average crossovers. So what's great about this method is that you can enjoy long run-ups without getting shaken out, without exiting too early. Okay, you just keep it mechanical and stay in the trade until finally the blue line crosses below the red line, and that's when you get out. And this would have worked out quite well because you would have enjoyed this big run-up, and then you would have avoided this long nasty downturn, okay, multi-month downturn, because you would have gotten out here and then you would have avoided all of this. Now that's easier said than done though, and that's where this little tip or trick is going to come in that I'm about to tell you, which is, a lot of people think they can do this easily, but then they see, so they're in the trade, they get in and fine, but then they're watching the candlesticks and not the moving averages, and so they see a sharp multi-day downturn. It goes from here during the day, it went all the way down here to the bottom of this candlestick, bottom of the wick here, and so from here to here, people get shaken out. They leave the trade too early. They know they should stick to the plan because the blue line is still above the red line, but they exit at the bottom of this wick here at this candlestick, and then they realize later that they got out way too early. Okay, so to avoid things like that, or here's another one, the blue line is below the red line, so they should stay out, they should not buy, but then they see this promising looking large candle here, the price goes up a lot during the day, and so maybe they're tempted to buy and just ignore the signals here, ignore the moving averages, and so again they're looking at the candlesticks and they're not sticking to the plan, and then so they break their own rules, and then bam, and they lose big time. Okay, so to help you avoid that, to help you avoid looking at the candlesticks instead of the moving averages, which you should be looking at if you're going to use this simple strategy, on stockcharts.com or perhaps in your own platform, you can actually remove the candlesticks. I've never heard anybody else recommend this. I'm sure somebody's thought of it. Alright, so in stockcharts.com you change the type under chart attributes from candlesticks. You got all different kinds. You go to invisible. Most people have probably never even considered this. Alright, and then click update. And guess what? The candlesticks are invisible. They're gone. Alright, and so now you can buy and sell just based on your plan. If you're using a simple moving average crossover strategy like this one with the 10 and the 20, you just buy when there's a clear break above here, like right about here, and then sell when there's a clear break below there, right about here. And you would have enjoyed that nice profit without being tempted to exit too early, or without being tempted to buy in when you shouldn't buy. Okay? And then you would have sold here, and you would have avoided all the pain throughout all these months here. Alright, so that's a little trick there to help keep you mechanical in a good way, help keep you, help you stick to the plan. Here's a tip or trick that you can use if you like to trade silver or gold or other precious metals. I like the idea of, instead of buying or shorting SLV or GLD, how about instead of that, use the mining companies. That way you can get some leverage, you get much bigger moves. Because let's be honest, silver and gold, they don't move that fast. Alright, there's not a lot of action there. Alright, plus the mining stocks are oftentimes cheaper, and so you can get in for less money. Alright, so I'll show you what I mean. One of my favorite mining stocks is Hecla Mining, which is HL, that's the ticker, alright? And I'm going to compare that to SLV, which is an ETF ticker that represents silver. So as we can see, Hecla Mining is much cheaper than SLV. SLV is about $17 right now. Hecla Mining is about $5, and so it's a cheaper way to get in and invest. And notice that if SLV is the blue line and Hecla Mining is the red line, we can see that it follows the same direction as silver, generally speaking, but it's a much more exaggerated move, and so you get some leverage there. All right. So instead of a gradual move upward, you'll get with silver, with the mining stock, it moves up much faster. Of course, it moves down much faster too. You get a smaller move, downward move in silver, and so. But if you're shorting, then you get a much bigger, sharper downward move. If you're shorting, you would have been very happy if you shorted Hecla Mining up here. You would have made a lot more money than if you had shorted SLV right here. Of course, you have to be careful. Leverage can be a very dangerous instrument. Okay. Now, of course, you can also get leverage for less money by using options, call options, and put options. But not everybody has options permission with their broker. Not everybody can afford to trade options. Maybe you are trading within an IRA, so you may not have options permission with your broker, that kind of thing. All right. And so this is a way to get leverage in an indirect sort of way. Let me show you another mining stock, which is AG, and that is the ticker for First Majestic Silver. All right, and again, we're going to compare it to SLV. As we can see, when SLV goes down a little bit, First Majestic Silver goes down a lot, and when for example, let's say silver goes up a little bit, trying to find where it goes up. Here we go. Silver goes up a little bit. First Majestic really goes up a lot more and a lot faster. Okay, so again, you're getting that leverage there, but please be careful with leverage. And as we can see again, it's at a lower price point with SLV around $17. First Majestic is only about $7. All right, so there's a little trick to get you some cheap leverage with precious metals, but please be careful with it. Use it cautiously. Alright, so those are my tips and tricks. They're very simple, and they can help you to improve your trading or investing with stocks and ETFs. If you like this video, please give it a thumbs up on YouTube, and please leave comments. And please subscribe to my YouTube channel so you can continue to receive the latest updates on my financial educational content. If you have any questions or you'd like some help with putting together a trading or investing plan, I can certainly help you with that. My email address is davidmodell@gmail.com. Thank you so much for watching and listening. As always, I really appreciate it, and I'll talk to you again soon.